Hello, I'm Aurora Davidson, CEO of Amerigo Resources. This is the third video in a series in which I discuss why Amerigo should be part of every copper growth portfolio and why it is a growth stock. In the first two videos, I introduced the concept of growth in a way that is different from what investors are used to hearing. This concept is growth in your personal return on invested capital. I explain why you should prefer this kind of growth over copper production growth in your investment portfolio. We've all been told that production growth leads to earnings growth and investors should get higher returns for that type of growth. But many things must go right over a long period of time for that to happen. And there's a lot of risk that isn't immediately obvious. Compare that with what Amerigo shareholders enjoy today, right now. In the previous videos, I showed you the powerful aspects of Amerigo's growth in return on invested capital. The consistency and the potential size of Amerigo dividends are compelling, especially in a world of rising copper prices. There are two major parts of the argument that I want to make in discussing with you why Amerigo should be part of your portfolio. The first part is the attractiveness of Amerigo by itself. I hope you downloaded the spreadsheet mentioned in the first two videos. The more you work with the spreadsheet, the more you will understand the strength of an Amerigo investment. But the story doesn't end there. In this new video, I'm introducing a second spreadsheet analysis. It's on our website, www.amerigoresources.com. It's actually on the second page of the existing spreadsheet, and we have labeled it as growth scenario. In this growth scenario, we modeled a fictitious copper company that wants to double production. To simplify the illustration, we assumed the company has the same financial metrics as Amerigo, and we used a 10-year time frame, which is the same period we used in the first spreadsheet. To level the playing field with Amerigo's current capital return strategy, this growth company maintains a minimum cash balance of $50 million. There are essentially no returns to shareholders because the capital is all used to pay for the project development and the interest and debt on construction loans. That means that investors' gains will come only from the stock price, which is subject to market sentiment at any given time. The spreadsheet will show you many things, but two of the biggest are the bad Ds: dilution and debt. Few investors understand all the costs of developing a project. Development work takes many years, during which substantial costs occur. Drilling costs to define the ore bodies, numerous technical studies, laboratory work, and the company's overhead along that long period of time. After development, the permitting phase takes place, which can also be lengthy. And when permits are finally in place, an even more capital-intensive phase, the construction phase, begins. In our theoretical model, the capital needed to advance the project is raised by selling shares. A company can rarely get construction loans until it completes a bankable feasibility study, which is the last and most expensive of all the studies. This is where the negative impact on investors becomes apparent, with the additional shares issued to raise money before a loan is available. That is dilution. Dilution means that when you finally get to split up the benefits of the increased production, there are more shares to do the splitting. This means a lower share price and smaller future dividends for everyone. More people putting their forks into the same cake means everybody eats less cake. The new growth scenario spreadsheet also really emphasizes the impact of debt on a company. When building a new project, the money must come from retained earnings, from selling shares, or from taking a loan. Debt is used to avoid more dilution than is absolutely necessary. But look at what the debt does to a company that wants to return capital to shareholders. First, a company has to pay interest on debt as soon as the loan is received, generally before construction begins. Those interest payments will continue until the loan is paid off. These interest payments are potential dividends to shareholders that will never be paid or shares that can never be repurchased by the company. In addition to the burden of paying interest, the second limiting factor of debt is the repayment of the loan principal. This typically starts when the company brings the project on stream. Ironically, as soon as the additional production starts, the positive incremental cash that comes in is offset by having to pay off the loan. The banks always get paid first. The spreadsheet shows how long this takes in a production growth scenario. It is eye-opening. Contrast that with Amerigo's situation. Amerigo has virtually no debt and little else to block the immediate and systematic return of capital to investors. If you examine the growth scenario closely, you will see that the effects of paying off debt are still heavily felt 10 years into the future. Forget the question of lost dividends for the moment. The stock price also can't re-rate higher because the company is not generating free cash flow. It's actually overvalued on a free cash flow basis. Remember that. Even after 10 years, the production growth scenario will continue to wait for that share price appreciation because it is still bleeding out cash. Again, contrast that with the expectations for a re-rating of Amerigo's share price. In the first spreadsheet, Amerigo's free cash flow increases over time. We know that Amerigo is undervalued compared to other companies generating free cash flow. That's based on the comparative free cash flow yields, which I discussed in the previous video. This new spreadsheet is a very powerful second part to our argument. You want Amerigo's growth in your portfolio, not production growth. Looking back at the first spreadsheet, we showed that the first part of the argument was the strength of Amerigo on its own. It illustrated the reliability and minimal risk of our operations. It illustrated the size and immediacy of our capital return policy. The first spreadsheet is a stark comparison to the second one, which contains a production growth scenario. The second spreadsheet identifies all the steps for production growth. As a matter of fact, we have actually used conservative assumptions that benefit the growth stock investment thesis. But it doesn't matter. When you look at the final column in both spreadsheets, the difference in return on invested capital couldn't be more compelling. There's an all or nothing aspect to a conventional growth stock that can't be avoided. Almost anything can happen to stop a project. And if you aren't paid until a new project is paid off, it's easy to see why your investment may involve more speculation than you thought. Contrast that with investing in Amerigo. In the first spreadsheet, don't just look at the final column. Look at all the columns to the left too. That is the totality of Amerigo's growth on display. This is why you should pick Amerigo as your preferred investment in the copper space. I hope you work with both spreadsheets and create your own scenarios. I invite discussion, and I'm happy to answer questions. You see, Amerigo is not about speculating on future growth. It's about receiving the benefits of the long-term rise in copper prices as quickly as possible. It's about the best kind of growth. Growth now in your personal return on invested capital. Thank you.